Some of you may remember this character from either reading your kids' stories or actually getting told stories, depending on your age. Of course, this is Eeyore. The reason I brought Eeyore up is, of course, a year ago when we had this seminar, the markets were crashing like crazy. Things were very bad. Rob also spoke before me. And I said to everybody, I felt like Winnie the Pooh getting up after Eeyore. So Rob, of course, has not changed. He's still Eeyore. And I just want you to know that next year, if you still are willing to come back next year, we're going to try to transform Rob through a series of daily injections and weekly counseling into Robbie the Pooh. And then it'll be a much brighter kind of conversation that we'll have. Unfortunately, for me, I have actually moved over to the dark side myself because I have some bad news to give you. So I'm now Darth Johnny. And we have to now focus. I want you to sort of go down memory lane, because one of the things that David talked about was how things started at the beginning of the millennium, at the beginning of the decade of the noughties. So I want you to think it's January 1st, 2000, you're getting over your hangover, and you're writing down the state of the financial world at that time. See if you can remember some of these things. For starters, the Canadian dollar was at 69 cents, on its way to 61.5 cents. 10 years before, it had been at 90 cents. The equity markets had been on a tear. They were up 1,400% over the previous 18 years. And NASDAQ was up 75% alone in 1999. Y2K would destroy computers and all life as we knew it, based on all of the projections. We'd all be survivalists eating out of tins somewhere in Kansas. And oil was only $25 a barrel. Gold was only $290 an ounce. And GIC rates were 5.5%, a distant memory, and mortgage rates were 8%. I just want you to think about what Rob said about the housing market. What would this housing market look like if mortgage rates were 8%? A lot different than it looks like right now. So keep this in mind, because that was the reality in 2000. Now imagine you're trying to predict how things will turn out 10 years later, but you're stuck in 2000. You don't have the luxury of hindsight, as David alluded to. So would you have predicted the following? Would you have said Canadian dollar is going to go over par and end the decade at 96 cents? That oil and gold will go up 300 to 400%, depending on which one you pick. That interest rates would go to zero on savings accounts, and you could borrow for a house for 1.9%. That the U.S. stocks would have their worst performance ever for any decade. Now, this is important to appreciate. Not worse since the Depression, worst ever. 10% lower rate of return for U.S. equities for the entire decade of the noughties over the 1930s. Hard to believe. And that $50 trillion of global wealth would be vaporized in a period of 18 months, and only a small part of that would have been recovered. Now, the reason I want you to think about that is the chances of anybody making even one of those predictions would be amazing. But to make all five would be outstanding. And that's one of the reasons why whatever we say today about the future, please do us a favor, don't hold us to it. We have no idea what the future is going to hold. Where's Dave Calababa? Dave. Okay, so Dave, a few months ago, sent me an email with a cartoon on it. And basically the cartoon says this: I don't want you to worry, but the guy who delivered the pizza was your financial planner. Now, Dave, was that personal? You just taking a shot at me? I took that hard when I got it, you know. The negative noughties, it wasn't just the equity markets that really didn't perform well. If you took a look at a variety of investments outside of equities, global equities, American, the NASDAQ, but a lot of other asset classes performed in a very mediocre way. So let's imagine you decided on January 1st to be diversified. If you put 10% into each of these asset classes, including GICs and bonds, and along with real estate and everything else, you still would have averaged a 2% return for the entire decade being diversified. So by itself, the diversification process didn't get it done. The only thing that we have from a bragging rights perspective is that over the last decade, we cleaned America's clock when it came to stocks. So we're not just better at hockey, we're better at equities as well. Of course, a large part of that was our dollar going up, and I'm quite sure that if there are any Americans in the room, they'll point out to me that 10 years from now, we'll be singing a different tune. And in terms of the issue of times are tough all over the world. As you know, if you're keeping track of the British pound, it's in the doldrums. It's almost the lowest it's ever been against the Canadian dollar. And as a result, a lot of very well-off people are having to do part-time work. Take the Queen, for example, with her part-time work in McDonald's. And on the other side of the ocean, we have Ben Bernanke, who's having to do FaceTime on cereal boxes in order to compensate for his reduced salary.